Hey everyone, today on the final bar, we're going to hit the market from three directions: top down macro, bottom up stock picking, middle of the road sector rotation. The S&P continuing its rally from Friday, bumping up against resistance around 3350, which just happens to be the 50-day moving average. We talked on Friday about that range between 3200 3400. We are smack dab in the middle. The question is all about the rotation, where we're seeing leadership and where we're not. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for our show. And going along this journey, breaking down the markets from a technical, behavioral, quantitative perspective together. It's all about connecting the short-term movements of what we're seeing today with the long-term trends. As I mentioned in the introduction, right, we talked about on Friday a little bit about that S&P range between 3,200 and 3,400. Essentially, the barbell that we can look at: 3,200 being the support from July, 3,400 being the resistance from August, and again in September. And really, we're sort of settling into that range. We broke to a new swing high today and sort of followed through the rally from Friday. And it's all about continuation. It's actually interesting to see financials so resilient. I'm getting to our shifting stocks segment. We're going to talk about Invesco is one of the handful of stocks, less than 20, making new 13-week highs today. But Invesco is one of them, ticker IBZ. So look at some of those charts that are working. Think about some of the ones that aren't as well. Now, coming up on the final bar this week, we've had some wonderful guests recently, and it's perfect timing because, again, when there's uncertainty, it's a pleasure to talk to some of these knowledgeable analysts, strategists, technical analysts to pick their brains a bit. Tomorrow, we have Jonathan Krinsky from Baycrest Partners. On Wednesday, John Kosar joining the show again from Asbury Research in Chicago. And then Thursday, joining us from Boston for the first time, Guy Cerundolo from Cerundolo Investment and Research. So a great group of guests this week. Really looking forward to it. As a reminder, we had our special event about a week ago announcing the new StockCharts ACPR Advanced Charting Platform. Check out on our YouTube channel conversations with John Murphy, Martin Pring, Ralph Akampora, Larry Williams, many, many more. Such a fantastic morning to and lead up to that, getting to speak to many of those guys. Our next segment is the market recap. Let's really focus on what we're seeing today. We're going to start on a chart of the S&P 500 just to focus in on the pattern. So we talked about this range from 3,400. That's sort of that purple shaded area, and I started that one back here in August. This is that run out of the July pullback, and you sort of settled into this range for about 2 months. This is just as it was bumping up against the February high. So you sort of have that level that clearly has meaning for the market before it moved and pushed all the way up almost to 3,600. Then on the way back down, we paused there and then continued on to 3,200, which is the level we've highlighted from the June peak. And then again, the pullback that you had here in July, found resistance, pulled back and tested it again. So both of those levels have really been solidified, I think, a number of different times. So I'm not surprised we came down to 3,200. I'm not surprised we bounced off of there. And I think regardless of what your longer term perspective is, this sort of makes sense. And so now we're at that key decision point. What we talked about a couple of weeks ago was, see the S&P going down to 3,200, that's going to be the decision point. And whether we break down and go to new lows, or whether we break back up, and I think a break above 3,400, above these swing highs here from the first 2 weeks in September would be really significant, would suggest we go to further highs, really retest the previous highs from early September. Again, if you had to, if I had to pick which way, I think, overall I would see further downside, only because I don't think what we've seen in the last 3 weeks to 4 weeks is enough of a consolidation, a pullback, given the extremity that we've gotten to, or the extreme high levels that we got to here through the end of August, beginning of September. But again, we break to new swing highs, break above 3,400. I think I'd have to acknowledge that that's in play. Let's look at some of the other movements that we've seen. So the S&P finished the day just above 3350, right around there. That's up 1.6. And again, Friday was the big rally, kind of coming out of the depressed levels. Follow through to the upside today, which is pretty impressive. Mid caps and small caps actually notably led the way higher, and I don't have it in front of me. I want to say small cap value is probably the best out of the 9 Morningstar buckets. That's probably the top performer, which is certainly unusual given the trajectory of what's happened up until now, but notably small cap leading the way higher. The VIX off a little bit, just around 26. Looking at some other markets, the dollar actually weaker today, coming off of the sell-off into Friday's close on the UUP, sort of continued lower, and the bond market's weaker as well, with the TLT down about 1/4%. On the commodity side, we've talked about the pullback in precious metals, gold and silver in particular. We're going to look at a chart of gold in a minute here, but actually a pretty impressive little bounce today, up 1%, silver as well. But I like the follow through. The last 2 days have seen sort of a bounce higher. And this is after gold and silver have both come down in a pretty big way, of course. We're going to talk a little bit more about sectors and everything in a bit as we go through these 3 parts of the analytical process. But I just wanted to point out energy and financials, really the 1-2 punch at the top, over 2%, both of those. With nice rallies, and again, energy rallying pretty well, oil up, prices up as well. On the downside, you had utilities still up, but up the least out of all of them, and then healthcare, consumer staples. So sort of a move back to some of these offensive groups, with consumer discretionary, technology also doing just fine. Let's look at some of the different asset classes as we complete this sort of top-down portion of the show. We talked about gold just primarily, and again, there are a lot of different ways to look at some of these markets. I tend to stick with ETFs mainly because they're very liquid and they're consistent. And if you're looking at different charting platforms, you'll get a consistent value on something like the GLD. Whereas if you're looking at spot rates and stuff, it always depends on your information sources. So I like to start with the GLD. And what we talked about with the GLD was really the low in March, the peak at the end of July into the beginning of August. Then we pulled back to the 38.2% level. That's off of the June low and the August high. Bounced around for a while. Then we broke down through the 50-day moving average. And now we have this confluence of support based on the 61.8% level. But also, if you take the low in March, the high in August, this is a 38.2% retracement of that swing, which also lines up with the lows from last November. So that's really this big up leg from the pullback at the end of last year to where we peaked out about 7 weeks ago. So that's a really significant support level. And again, on a pullback, that's a pretty reasonable place, I think, where you'd expect some sort of consolidation or bottoming. Today was a nice bounce off of that sort of general area. And again, I think as long as, given the pullback, as long as we remain above like 171, which would be that last Fibonacci level, I think you're in pretty good shape here, and you're getting gold after a pretty fair pullback from 194 or so down to 172, right? I mean, that's down 20 points in the last 7 weeks or so. If we would break down through 171, sort of complete a breakdown through those levels, I think you'd have to reevaluate this and look for some further support levels, some further downside. And unfortunately, I think you're going down here to the 200-day moving average, also retracing 100% of this move, and you're going back to the lows from May to June, which is in the upper 150s. But overall, we're sort of right at that sweet spot where you might expect some sort of meaningful support. The dollar we've talked about, we'll look at the UUP, but again, the dollar index is really important. I think this transition from weaker dollar to stronger dollar was off a bit today, but overall, we're still seeing higher highs and higher lows. And I think watching for that pattern to continue is an important one, certainly going through year end to pay attention to. Finally, just looking at bond markets, we usually look at the TLT, and they're sort of holding steady here. The RSI on the long bond ETF is literally almost to the penny right at 50, and an RSI of 50 essentially is the absence of momentum. It's a sideways trend. If you look back to where the RSI has been 50 for the TLT, it's sort of these consolidation periods, and that's absolutely where we're at. I don't have the Bollinger Bands on here, but it might be interesting to put those on because the volatility has come in, the bands are going to narrow, and what John Bollinger would say is that means you're getting ready, you're getting prepared for a break. Either you break to new price highs or break to new swing lows, right? You break out of that consolidation that we've set so far. So it would be interesting to see the TLT now that we've sort of narrowed the range and see which way the momentum takes hold going forward. Let's move on to our next segment, sector setup. So the second step of our normal routine of breaking down the action in the markets on a Monday, starting with the top-down macro picture, we've seen stocks pull back, gold pull back, bonds consolidate after the last couple of weeks. Let's see which way we break from here. Now let's look at the second piece, which is the sectors, the 11 S&P sectors, and where we're seeing opportunities. We're going to start with the daily RRGs. This is looking at just the last week or so on these RG readings, and we've seen this vertical nature to the RRG the last week or two, as you've seen materials, which continues to be the strongest of the 11 sectors because it's further to the right. You can see it's actually heading southwest. You've seen the emergence of industrials and materials, but now they're rotating back down. So still performing well on a relative basis, but the momentum sort of coming off that outperformance. You can see financials, same thing, and all of these sectors kind of rotating into this weakening quadrant, sort of a similar type of pattern. What is improving, and again, still underperforming, but the momentum starting to come in a little bit, technology, communication services, which are over here on the left side. So seeing whether this rotation continues to come on as technology is back in the improving quadrant, again, on the daily time frame, the shorter term time frame. I think that's pretty interesting to watch. Now, looking at the weekly, this is a little more of a longer term view, and now you can see some of the trends that we've talked about with industrials really rotating more in a position of strength, materials as well. Again, what concerns me is on both of these, you see materials kind of heading southwest. This is obviously related to the weakness in commodity prices, in particular gold and silver coming off. So those stocks related to that, mining stocks and elsewhere, sort of coming off, but overall still in the leading quadrant. Notable on this longer term time frame, consumer discretionary and technology both sort of remaining in a bullish configuration. Technology is doing what I've often found is sort of the most compelling signals, which is when things kind of rotate clockwise sort of further to the right. That's sort of a relative trend that keeps working, and it's just the momentum either is improving or pulling off. And we're going to look at a chart of the FANG index in a little bit, and sort of makes sense as to why this chart sort of looks like this, with the weekly sort of furthest to the right, kind of dovetailing back northeast, and on the daily one, it was sort of rotating in a positive direction as well. On this longer term time frame, you see some of this emergence of the defensive sectors like utilities, real estate, consumer staples, kind of coming out of the lagging quadrant into the improving quadrant. And again, we'd have to see if that, I think on, again, further downside for stocks, if you see people getting more defensive, you'll see this rotation continue. If, however, you get a reemergence of the growth trade, you get a rotation back into tech and consumer, similar to what we've seen Friday into today, I think you would see these sort of remain on the far eastern side of the scatter plot of the RRG heading further back. So I think that's some of the patterns to pay attention to. And again, industrials and materials have been two of the better stories on a relative basis. And again, taking a bit of a pause here, materials more than industrials, but be worth seeing if you continue to see some weakness there. Let's look at the 11 sectors, sort of the 30,000 foot view. This is using the candle glance page. And what jumped off at me over the weekend reviewing these pages is how many of these look sort of like the bull flag pattern that you've potentially gotten in the S&P as well. That's when you have a big run and then you have a pullback, sort of a parallel pullback of lower highs and lower lows, but contrary, sort of a contrary move to the longer term trend. And if you break out of that pattern to the upside, you usually suggest further upside. And if you look at a chart of the XLY, we're right at the upper end of that flag. So again, you take this as the run. You have lower highs, you have lower lows. I didn't draw the channel lines, but you could see a parallel relationship between the lows and between the highs here coming off the first week in September. We're sort of testing that upper boundary. We've arguably started to break through that today. So if you get follow through tomorrow into the remainder of this week, I think that would, certainly speak to strength underlying things in consumer discretionary. You also have similar patterns in places like consumer staples. So seeing whether or not that's able to we're able to follow through that tomorrow is certainly going to be compelling. So we're right at that point where the bounce off of these swing lows in the last couple of days certainly impressive. The overextended nature of the markets, I think, was absolutely the case. We've now pulled back, which I think is absolutely reasonable. The question now is, was that enough? And seeing if some of these patterns will resolve to the upside, I think will be a pretty good way to do it. We're thinking about the sectors and looking at energy. Again, a day like today where it's leading the way higher, that's great. Love the fact that it's up over 2%. That's impressive. overall, is this still technically an attractive place? Absolutely not. I would tell you, and again, the relative strength continues to be relatively weak. And if you look at the longer term trend, energy, you've not been paid to own energy much at all. Really just the March to June high, the March low to the June high, you did well on a relative basis. But if you take that part out of it, think of that as a reaction off the lows. I mean, the long-term trend just remains really negative. And as a trend follower, I think your goal as a technically oriented investor, identify the trends and stick with them as much as you can. Then have a set of tools to recognize when the trends are reversing. I don't see that, especially the relative trend in energy, really improving yet. If and when it does, I'll be the first to point it out on the show, and I'll tell you, energy's starting to work on a relative basis. But overall, I'm seeing lower lows, lower highs in price, lower movements in the relative strength, continue to make 12-month lows. It's not the kind of thing that gets me too excited. Healthcare, by the way, just we only don't have time to look at the chart, but I just want to point out has a similar sort of bull flag pattern potentially emerging there. Last one I would talk about is financials. You know, pretty interesting to see some of the improvement in financial stocks, and stocks like IVZ are on the new swing high list that we'll review in our next segment after the break. But I just want to point out again, it's coming off a fairly depressed level. So when I look at the XLF, you know, you sort of have these lows around 2250 to 23, and we're you know, sort of right in that spot where you might expect a bounce. So a nice little improvement today for sure. Again, with energy and financial sort of the top two, the relative strength still very muted, still below 2 moving averages. So you'd want to see something like this actually be able to you know, improve over the 200-day moving average. And I think from there, then it still has more to prove, because you've had this resistance right around 25.50 that's held a number of times now. So I think there's a lot of overhead resistance on a sector like financials. I don't see it as a great opportunity just yet, but again, a day like today, you have to notice it, and you have to look particularly in individual stocks, and that's where I would maybe close this discussion about sectors. When we're thinking of the 11 S&P sectors, it's more thinking of allocations into cap-weighted sectors. I think within all of the 11 S&P sectors, with maybe the exception of energy, I think you could find some opportunities. You're going to find stocks that actually are fairly attractive on a technical basis, especially over the long term. So I think there are opportunities out there. I think this is more, you know, looking at the 11 sectors from an allocation perspective. Let's take a quick break. We're going to be back with my next segment, Shifting Stocks. We'll see you in a minute. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we love to hear from you, in particular questions you're running into as you review the charts in your chart lists. Shoot us an email with any questions that you have, thefinalbar@StockCharts.com. You can also get us on Twitter at FinalBarSCTV, or on our YouTube channel. Just put a comment below the videos. We love to capture all of those, hear what you're thinking, what questions you have, and we'll have another mailbag segment on Tuesday, tomorrow of this week. We'd love to answer one of your questions on the air. Our final segment today is called Shifting Stocks, and this completes our three-pronged approach on a Monday, starting with the top-down macro, and then going to the sectors and the 11 sectors, how they're rotating, and then finishing with individual names. What we're going to do today is actually go through stocks making new swing highs, and I wanted to do this just to illustrate that even as the S&P has pulled back, even if it's you know, potentially forming a bull flag pattern, and with some of the sectors we're seeing that same thing. The question with a lot of the charts is whether they've pulled back enough, given the strength up until the last couple sessions. You know, there are stocks that actually look very different and actually are holding up just fine and making new swing highs already. I wanted to focus on those. What we're doing is we're going to use the scanning engine for that. So if you're not familiar, if you go here on your dashboard to the scanning section, you can create a scan You can edit any of the scans that you have. I have one that I run pretty regularly called SPX 13-week highs and another one for 13-week lows. This is the results of the scan. I ran it just about half an hour ago, so it might not be completely updated given where things closed out, but because it'll run them intraday basically on what we're doing. But here we're basically just saying I want to know where today is making a new 13-week high or 65-day high. And I'm just looking at the S&P members. As a reminder, when we look at these groups, you know, I tend to use the S&P just so it's names that we're all familiar with as we're looking at examples together. In your own process, I'd encourage you to look at other universes. Look at a broader equity universe. Look at mid caps, small caps, non-U.S. stocks. There are plenty of ETFs. There are plenty of things you could do to apply some of these screens to another universe for sure. So looking at a large cap space in the U.S., these are results. I had 16 stocks when I ran this earlier, making new 13-week highs, closing highs today, given where they were trading about half an hour before the close. And a couple of observations just very quickly here. Number one, really two sectors that are dominating this right now: consumer discretionary and industrials. And I've sorted it by sector just to demonstrate that phenomenon here. You'll also note a couple other represented. I mentioned Invesco, and this is why it's top of mind as I'm going through the show. You also have Seagate within technology. You have Consolidated Edison within utilities. So we have 16 charts. Let's start at the top of them and just start to look through. I dumped them into a chart list just so we could review where they were at. We'll refresh this, giving the closing prices. Let's go through them individually. So again, the two main sectors were consumer discretionary and industrial. So we'll start in consumer discretionary. It's interesting to see Aptiv APTV as one of the consumer names. You know, so on a closing basis, again, it closed just above 90, and that's taking it above the previous closing high, just barely here from the first week in September. So while the overall market is sort of down like this and pulling back and now, you know, threatening to break out, this is actually never really broke down. If you look, the support around 82.50 is kind of held pretty well. It bounced off the 50-day moving average a number of times, and now again sort of resolving back to the upside one more time. Not quite a relative high for the last 6 months, but close. So I really like the setup here. This is within the auto parts group. Dollar store is actually holding up pretty well, in particular Dollar General. And this is actually, I like charts where if you don't know the overall pattern of the S&P, it might not be obvious looking at this particular chart. So if you think of the chart of the S&P, it's sort of continued off from a September high, sort of continuing lower. Look at how Dollar General just kind of ignored that and has continued to chip away on higher highs and higher closes. And it's making a new 52-week high even today on a closing basis, up almost 0.7% today. Domino's has held up pretty well, and on the pullback that we've seen recently, again, it broke down through the 50-day, which is not ideal, but it's held sort of this 375 to 380 range as support a number of times. And stocks that hold support, I'm a fan of that, and I like the fact that it's making a new 52-week high again today on a closing basis. Not quite overbought, so potential for further upside. This has sort of a cyclical nature to it, so that's one thing I would be watching to see if it's able to sort of follow through to the upside. Continuing within consumer, Darden is actually a pretty compelling chart in any environment. Stocks making new price highs, making new relative highs, chipping away, breaking above resistance, breaking above moving averages. It's actually a lot to like about that chart. Sort of a classic sort of base breakout that we've seen, the retest of the 200-day resolving to the upside, and it's just testing big round number support. I've written about that before, about sort of big round numbers, and 100 tends to be a level of resistance just because psychologically that's when you revisit whether something deserves to be a 100 handle there at the top and deserving a 3-digit price. So we'll have to see if it's able to hold above that. L Brands is a fascinating chart. You can see how it's actually held up pretty well on a price basis. The relative line is what's most impressive to me. So it's held up while everything else, for the most part, a lot of things, right, have sort of pulled back in the month of September. It's actually holding up really nicely, making a new closing high today. Really close to it there, I think, based on the closing price, whether it got above that first week in September. But the relative strength making a new high is what's really impressive to me there. Target actually looks pretty similar. This is obviously within consumer discretionary as well, making a new 52-week high. Relative strength has been good. What concerns me about a chart like this is the potential for a bearish divergence. For that to happen, you'd have to stop this uptrend and solidify the lower peak and momentum, which we've not done yet. Whirlpool, we've talked about in previous shows, looking at stocks making new price and relative highs, and it followed through on Friday's bounce, sort of going to a new high today, closing around 185. That's for consumer discretionary. Again, pretty impressive group of charts. And again, in general, if I own charts that are going up, I'm feeling pretty good about my list of holdings. Invesco are now in financials. The only financial stock that came out of the screen was IVZ. What's interesting here is it's testing the upper end of this resistance range, testing the 200-day moving average. You'd really like to see it break above there, but nowhere near overbought yet, which is what's kind of exciting. A bunch within industrials. We don't have a lot of time, so I'll just go quickly through some of these charts. Copart CPRT is the first one. You also have John Deere DE, which is really threatening a new high. It came back down right to close at the previous close from mid-September, but overall pretty good. Here you actually do have a bearish divergence here with the high in mid-September versus the lower peak in momentum. So I'm not thrilled about that. Thinking of the overall, but again, overall, as long as it holds above support, I think that's pretty good. We've talked about FedEx and the strength of this chart. It continues to impress, making new price and relative highs, which I think is pretty solid. Martin Marietta MLM is another one. Looks similar to one of the previous charts that I've already forgotten the ticker, but looks similar to that, sort of testing the upper end of resistance and now resolving to the upside after finding support of the 200-day moving average. That's a nice chart. We talked about the Uniteds recently, and UPS, similar to FedEx, is breaking new swing highs as well. VMC Vulcan is the last one within industrials. Finally, we have a couple more. Seagate STX reclaiming its 200-day moving average. This is a part of technology that has not been outperforming as much as the XLK, but look at how the relative strength has really rolled higher in the month of September, and it's really rotating from distribution to accumulation. I really like that as a long-term chart for potential upside. And then finally, Consolidated Edison. This is a higher yielding name within utilities. The only utility stock that comes up on the screen, but making a new 13-week closing high just barely, because this close from early June is beyond that 13-week window. So again, that's not the be-all and end-all, but I found reviewing this list of names, and this is just the large cap space. I would look at mid caps, small caps as well. Routinely look for stocks like this because you'll find charts that are sort of outliers. Stocks making new 13-week highs. There's usually at least a couple names on this list. Might be some fodder for potential upside in those tickers. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the S&P market trend. On Friday's show, we reviewed this in a little more detail. So if you missed it, certainly go back there. One of the things that we've talked about is this medium-term signal, which for me is sort of the main signal. The long-term one is trying to capture, bigger picture trends, but it'll wait a long time for a sell signal. The short-term trend is just a placeholder. Really, the daily chart is the way I track short-term strength and weakness. This is really the sweet spot, which is that medium-term trend. It's trying to tell you about the next, a couple of weeks, next couple months really is sort of, if not a little bit longer. And here you can see it did not register a sell signal on Friday because of the rally. It would have done it had the week closed in Wednesday maybe of last week, but didn't do it. Today with the rally, you're seeing things evolve. And again, we could, depending on how the rest of the week goes, register a sell signal. That's why it's a chart I'm certainly paying attention to. You don't update that until Friday's close, so don't get too excited if you get a signal midweek. Chart number 2 is the New York FANG Plus Index, $NY FANG. We've looked at this index before, and it's not just sort of the traditional FANG stocks or mega FANG man, whatever you want to call them. It's also some other names that are sort of related in that same bucket. The FANG index is bouncing off of an ascending 50-day moving average, which again, all else being equal, is a pretty decent entry point, assuming further upside. And I think we're right. Similar to the S&P, I think we're at the point where this breaks down through 5,000, breaks down through the 50-day moving average, or breaks above 5,400 and sets a course for 5,800, returning to the previous high. So I think this week is pretty key to see whether we break out of that congestion range we've been in. Finally, I just want to point out advancers, decliners. So last week we had one just barely almost a 90% down day. It didn't quite get there, but it was close enough for me to call it a 90% down day. Today we did not quite get a 90% up day, but that was something I know for myself and others we were looking for, to see if you get 90% advancers versus decliners. And again, in general, what that means is bull market phases tend to see clusters of days where at least 90% of the New York Stock Exchange closing higher than yesterday. Down tapes tend to have 90% down days. We've had a 90% down day, just barely, have not had a 90% up day yet. That's something I would be looking for, certainly for the remainder of the week. Folks, that is our show for today. Thanks for walking through these 3 steps with me. I hope you can think about your own process and where you could upgrade that in your own routines: top-down macro, sector rotation, bottom-up stock picking. The scanning engine is great for that last piece, by the way. Send in your questions to us via email, thefinalbar@stockcharts.com. We'll do another mailbag segment tomorrow. For StockCharts.com in Redmond, Washington, I'm David Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.